Do you know that more than half of all American workers say that they're dissatisfied with their jobs? You won't find any of those folks on this podcast. Hello, everyone, and welcome to Between Tides, where each episode features fascinating careers and the people who make our lives better through their work. As our occupations continue to evolve in an ever-changing world, we no longer ask, "What do you do for a living?" We think the better question is, what are you living to do?
Well, welcome back. It's so nice to have you here again. You know, we refer to you now as our financial gurus, so that's a lot to live up to.
Well, we also stepped into a new space here as well. So
Yep. Yeah, this is our new space. We really like it. It's a little bit cozier. We're not constantly, looking side to side like we were. So yeah, welcome. It's so nice to have you again.
Yeah.
I don't know, have you met Tim before? This is Tim Kaloje. He's here with us.
Welcome, gentlemen. Pleasure to meet you.
Thank you.
Yeah.
Thanks for
Nice
having
to
us.
meet you.
Appreciate it.
I'm not going to say we typecasted Tim
But
for
we
his
did.
age, but we totally did.
They asked for someone older to come
Yeah.
in. So.
We're going to talk about retirement and preparing for retirement. So we thought we don't want the young ones in here. We want the people who actually have some skin in the game. So, yeah. So you're ready to kind of dig into prepping us all for the golden years of retirement?
we are, and this is I would say this is where the most meat comes into play, right? For younger people, there's a lot to do, but this is kind of the main focal point of planning, right? Because you have a lot of moving parts, right? It's typically the point in people's lives where the most things are going on, and thinking about saving and retirements kind of in the forefront for 10 or 15 years during those last moments. So yeah, we're real excited to dive in and say what we know.
Okay. Well, I hope you know a lot because we have a lot of questions for you. So on a scale of 1 to 10, Tim and I are in our 50s, right? We're both in our 50s. So we actually are thinking, retirement could happen in the next 10 to 15 years, probably. How critical is it where we are in our stage of our careers? We've passed kind of the arc of the midpoint. We're probably at the higher end of our earning capacity. How important is it right now to be planning for retirement and making critical decisions?
It's extremely critical now, right? So everything you're doing, right, the lights at the end of the tunnel, so to speak, right? It's getting near. It's something you're starting to think about. Again, when people are early on in their careers, it seems like such a distant thing that's going to be happening. It's very easy to say, well, I'll scale back my 401k contributions, or I won't do the IRA this year. I have 30, 40 more years of working, this and that. But at this point, everything matters, right? Everything's so close, and little tweaks and decisions you make now could be the difference of retiring at, maybe 60, a year too early, or maybe being delayed, going to 65, 66, right? So at this stage, it's really where you want to start mapping out. You have an idea of your life, your lifestyle. You have an idea of the home you live in or what you want to be doing in the next 10 years, right? If you've started a family, you kind of see now, okay, maybe I have children. I understand what they want to do with their lives in the future. So it's the point where things can get real, right? It's all coming to fruition, and you actually have some specifics to work toward, and you kind of know where you're at in your career. When you're early, I'm doing this role right now, but in 5 years, I might switch cities, I might switch careers, I might, a whole host of different things that may change your trajectory. But at this point, you're pretty comfortable, right? And so it's an exciting point because you can really start mapping those things out. It's a little daunting, right? Because it's a huge next phase of life, but it's also really exciting because you're planning for this thing you've worked for so long, and that's retiring and enjoying it, and whatever that means for the particular individual.
So if we look around, I think we see two things happening simultaneously. I mean, we're all getting a little bit older, but at the same time, people are living a lot longer than they have in past years. How should that make our outlook different toward our financial planning?
So when we do retirement plans for folks, we try to be very conservative when looking at. We use below average rates of return. We use longer life expectancies than just the average, right? We tend to use age 90 right now for our folks that are in their 50s, where, average life expectancy is probably closer to early 80s, depending male or female, right? And, that is something that we want to make sure, hey, as people are living longer, that they don't outlive their monies, right? Most people would rather say, hey, I want to have something left in the bank at age 90 versus,
Sure.
nothing at all and just living off Social Security at that standpoint. So it's important. And, you have a lot of people too that say, hey, my grandfather passed at age 75. My dad died at 75. I'm not going to live much longer than that. But you don't want to plan. You don't want to plan in that way. You want to make sure, for a longer life, right, than probably your ancestors, right? And there's just medical advances. Sometimes, we've seen people with a CPAP, for example, right? They had gotten a CPAP and now they live much longer than their ancestors, and maybe that's something they had an issue with. So we think it's important to plan for the longer term than the shorter.
Yeah, I like that conservative mentality. That's a really hopeful or a really helpful idea.
Yeah. And if you can plan for sort of below average cases or, worst cases, and you see what your life looks like, anything on the upside is, right, the cherry on top. So if we're using more muted rates of return, that's great. If the market does better, obviously your portfolios go up, and
Sure.
right, it's a little bit more flexibility you have. It may be an extra trip you take or this and that, but if they are in line with more lower rates of return, or if you do live longer, obviously that's what you've planned for as well. So you're kind of living with that expectation. So everyone can always handle the upside, right?
Right.
But it's really the downside you want to plan for. Like, hey, am I okay if I retire at 65 or 67, living off of this budget, planning to live till I'm 90? And if that works for you and you end up having a little bit more, that's going to be fine, right? What you want to do is just make sure that baseline and sort of that lower level you're okay with.
Well, and a follow-up, Tim's question, I feel like people are retiring at much later ages now than they were a few decades ago. I mean, my parents' generation, which is the classic boomer generation, it was pretty typical to retire at 55. And now we're seeing 65 is now more of the norm, and even later than that. So are people doing that by choice, do you think, or by necessity?
I'd say there's both. Definitely during COVID, we saw a lot of people leave the workforce, right? That weren't planning, that maybe 65 was their target, but they were 62 and they could do it. And they were
like, I'm out of here.
Yeah. There's a lot of changes going on, for good or for bad. Right. And they decided, hey, they were going to leave the workforce.
Okay.
I think it depends too, the background of the person. There are some people that just want to continue to work forever and they can retire, right? Maybe they want to know that comfort. So when they have those days where they're, saying, hey, I need to get out of here, and just having that comfort of knowing that they can retire, right? But there's a lot of people that haven't saved a lot of money for retirement, and they do need to continue to work.
Yeah.
If you look out there and looked at the average amount that folks have in retirement accounts, it's not a great average, right? And there's a lot of people that can't afford to retire, right? And there's been a lot of inflation and things over the past few years that have made it more difficult for folks to be able to retire, that maybe were on the bubble, or they didn't start saving young, or things do happen too. We understand that. So,
and to add to that point, there's been a shift as well for what retirement looks like for people. used to be a lot of people had pensions, right?
Yeah.
And they were getting a pretty high fixed payment, and they could live off of that. Nowadays, pensions are more rare, right? Some municipalities, things like that, you could still receive a pension, or if you're a teacher or something, but most people now have to save on their own. So as Nick was mentioning, if you're not doing that, you're not going to be able to retire much. So that extends how late people work. I think another factor is the type of work has changed as well. Going all the way back, if you were, working in a steel mill, you wanted to be done, right?
Physically,
you couldn't handle it. And there's, many more jobs now that people can, at an older age, still do at a high caliber, right? You can, we see it in the accounting world all the time. You'll see an accountant who's, 70, 75 years old, and, they like what they do. They like their clients, and they're able to continue working, right? You weren't able to work in a steel mill till you were 75. So it's a number of things. I think financially, though, the biggest things are you're losing pensions. Social Security is not quite enough to fully live off of and have flexibility with your life. You can make it work. Anyone can make, anything work. But I think a lot of those factors play into why people are, having later and later retirements, and also people, like we said before, they're living longer.
Yeah.
So can I double click on that then? What if I'm one of those people who really enjoys what I do and I don't want to retire? What does that look like then for my financial planning?
Yeah, so even though you may not want to retire, again, it's having that comfort, right? And, you have to pick an age to say, hey, to know I could retire at this point. So if somebody says, hey, I'm going to do this for as long as I can, right? We'll say, hey, well, if we had to pick an age, right, to say, hey, when do you want that comfort of knowing you could retire by this age? How do we plan accordingly to that, right? And if they don't, say if they picked 60, right, and they said, I'm really enjoying work, I'm going to actually work till 70, right? They may want to look at their portfolio and adjust that based on, when they're ultimately going to need to start taking those monies, right? Because if it's the other case, for example, and you're 59, you said, I wasn't planning to retire, but I'm going to retire next year at age 60, right? You want to make sure that you have your underlying investments in line, right, for starting to need distributions in a year, right? Because you don't want to have an event happen where, for example, you're 59 and it's 2006 and you said, hey, I'm going to retire next year, and that was earlier than you were planning for, and you were 100% in equities or stocks, right? And next year happens, you didn't adjust anything, and now, what you had saved there could be half of what you had, right? Because you were within all stocks. And then you need to start taking from that monies, and it can't regrow. Yeah. Right? So that's something called the sequence of returns, and it's out of anybody's control, right? To say, hey, what is the market going to ultimately do, right? So you want to make sure, your retirement assets are invested properly for the timeline that you're going to be needing those. So,
and you may want to work, you may not be able to work, right? You might say, it's fine, I'm going to keep spending at a high level. I'm, 65, but I want to do this till I'm 75. I have 10 more years of runway. So I'm not going to worry too much because I have income coming in. So I'm going to keep spending and at a high rate. But the older you get, typically the more health issues you tend to have. So you may not be able to continue working. So it's important to also know, can I stop? Like you said, what's the budget if I need to? And also you may want to work, but your employer may not want you to work anymore, right? There's some
not to work. Yeah.
Right.
Well,
there's people at an older age who can work at a high caliber, but
Right.
we've all seen it. Sometimes you're somewhere and you're like, this isn't the good role for you right now. It's,
Or they just want to get rid of your, if you're at a high earning capacity and they could bring in someone younger and pay them less. That's a reality for some people too.
It is, absolutely. So it's still important to know, right? Everything again goes back to that sort of the cherry on top. If you have the ability and you set things in place and you're properly allocated, you ran the budget, you feel comfort knowing if something does happen,
Yeah.
I'm in a good spot nonetheless, right?
So thinking about that, when clients come into you and they're saying, "Okay, I'm 52. I'd like to retire at 62, if that's possible." What's a number that you, I know you're probably not going to want to give me a specific number, but what's a general number we should be considering? People say, when I hit this number, I'll know I have enough for retirement. So if someone's going to retire at 62 and you're saying conservatively, we're planning for you to live 30 more years, what do they need to live 30 years in this market or this economy at a relative comfort level?
Yeah. There's no general number to say, hey, have $1 million saved and you're going to be fine.
You're good.
Right? Because it's really driven by what your lifestyle is. And it's not what you need in retirement, but it's what you want. You know, for example, we tell people, hey, you know, we want a budget of, hey, you're retired today. You know, what is your budget for retirement? And we want people to focus on, don't give us just, hey, this is bare minimum expenses just to get by, but what you want coming in.
Do you want to travel? Do you want to be able to give gifts to your kids and grandkids, things like that?
Right. And everybody's different because some things are discretionary for some people and some things aren't discretionary for people, right? A big one is giving, right? Some people say, hey, giving has to be a part of my budget, right?
Yeah.
It's not just, if I have it, I can do it. But that's something that's very important to me. That's a discretionary expense, right?
Yeah.
Everybody's different in that aspect. So it's coming up with that budget, right? And what kind of lifestyle you want to have. Because, we have clients that have a lot of money and, they're going to outlive or, they're going to outlive. They have plenty of money to live and, they live well within their means and they could spend a lot more if they wanted to, right?
Yeah.
It just depends on what retirement looks like for folks. Because there can be other factors too. Maybe legacy is a part of that, where they want to pass something down to their children or
I want to
charity.
spend every penny. My kids are on their own. I'm kidding.
On record.
Yeah. You heard it here.
Yeah. And it's, everyone's different how they spend. Some people are willing to forego some luxuries in retirement to be done.
Sure.
Right? Some people are not. They say, I don't want to, eat ramen noodles every day. I want to go out to dinners and see shows. So I'm going to work a little longer. So I can have that. There's some general things you can find online to help people gauge, right? Retirement at its core is a function of inflows and outflows, right? You're going to have some money coming in right now. Social Security's in place, maybe you have some pension. You're going to have things coming in. Then you have a budget. You have expenses. Well, if what's coming in is less than what's going out, you need to supplement. And that's where the money you've saved comes into play. 401k, an IRA, maybe just money on the outside in a bank. You can find all sorts of different things online. Generally speaking, 3 to 5% withdrawal rate from a portfolio can last you through retirement. So that's a quick way for people to maybe see more of a gut check, right? Like, am I remotely in line? So if you have a $1 million portfolio, $30,000 to $50,000 a year, you could pull out. Obviously, that's dependent on how markets do and everything like that. But for anyone watching, if you want to sort of calculate it out yourself, it's one way to do it. See what your budget is. That's the biggest thing. It's shocking how many people we work with don't really know what they spend, or they throw out arbitrary amounts and we're like, okay, well, something's not jiving. We can see you're not saving. We see how much you make. So no, you're not spending, $3,000 a month. That's not how it works. So everyone can kind of do that little test there, but once you're working with advisors, it's obviously a bit more robust.
Yeah.
That's where we're using Monte Carlo simulations to have various outcomes to say, okay, if there's, the first few years of retirement are bad years in the market, how does that affect things? If you have really good years, how will that affect things? So not everything's linear in life, as we know. So
Not with finances, that's
Yeah.
for sure.
And the Monte Carlo that Vasily was talking about,
That sounds exciting. What's that?
So that's what it does is it's to run like our software, for example, that we use for retirement planning. It runs 1,000 different simulations with rates of returns, right, as well as sequence of returns, right? Okay. And it says, okay, based on these 1,000 simulations, how many times is it a successful retirement? And successful retirement means there's money left at age 90, right? And it'll give them a probability of success, ranging from 0 to 100%, right? So that's what that Monte Carlo analysis is just to come up with, okay, what is my probability of a successful retirement?
Okay. Sounds a little nerdy. Monte Carlo makes it sound really exotic.
Yeah, and then when you get the definition, you're like, wow.
It's kind of nerdy in a good way. Do you have a number for yourselves? I'm just curious. Like, have you guys picked an age where you're like, this is when I want to retire?
No.
Yeah.
I'm kind of in the boat. I just would like to be able to retire at 60 if I want to, but I really like what I do. So
yeah.
I mean, he mentioned accountants earlier, but you see a lot of folks that sit in our shoes too, and they work a long time because it's not a physically straining
as
job.
long as you have the mental acuity to do it.
Exactly.
Yeah.
Exactly.
My husband has said the same thing. He's in a similar field, and he'd like to retire earlier rather than later, but he still sees himself maybe consulting or working, in some kind of part-time capacity because he enjoys it.
Yeah, and if you enjoy it, it gives you a sense of purpose. It gives you something to do. It keeps your mind sharp. It's not a bad thing. I think what everyone wants, like for me, I have a number where I want to have flexibility by.
Yeah.
Like I want to know by a certain age, okay, I'm not having to do this or this or that. Like I am good now. However long I go, who knows? It's all going to be dependent again on things like health and, what's going on in your life. And, right now, I think the frustrating thing for some people of, older generations is technology.
Mm-hmm.
They want to keep working, but they just can't keep up learning all the new things,
Yeah.
right? Internet, okay. And then, Word, Excel, but then now getting into AI and everything, it's, sometimes too, it's you want to keep going, but the world's just telling you, it's your time. So I think, the flexibility number is what, I have in my mind at a certain point. But I'm like, if we both love what we do, we talk about that all the time. So it's easy to kind of push that number back because.
So let's talk a little bit about Social Security. It's not the same today. The benefits are not the same today as they were in the 80s, right? Like there are less amounts of benefits being paid out. Is that accurate?
I don't think that it's less benefits are being paid out, but the taxation on Social Security has changed over the years. So, for example, 85% of your Social Security is able to be taxed. So, just to make the numbers easy,
Wait, so they tax us on the income. They took the Social Security out, and then they tax us on that too?
Mm-hmm. Depending on what your income is in retirement, you could pay zero in taxes for Social Security.
How do I do that?
Your income, if you were just living off Social Security in retirement, most likely you wouldn't be paying taxes on it. But
can anyone actually do that? Can you live off just Social Security?
Everybody's different. I mean,
I think the maximum right now, I want to say, is around $3,800. Like if you were a high earner, is that right? A month, yeah.
Yeah.
So
you could.
You could,
probably,
if
you had everything paid off, and
and if both husband and wife were both getting that.
Yeah, that's true.
Yeah. The tough thing with Social, because you have to determine what age to take Social Security at.
Yeah.
Too, right. And you could take it as early as 62 or as late as 70, and it grows. The longer that you wait, right? And, unfortunately, the people that need it at 62, right, are your people that aren't making as much income, right? And they have to take it earlier. But there can also be penalties for taking your Social Security and working and earning too much.
Okay.
So if, for example, if you start taking Social Security before your full retirement age, and you're still working, if you make over, it's right around like 23,000. It adjusts for inflation every year, but if you make over 23,000 a year, there's a calculation where you would have to give some of your benefit back. Now that would continue to grow for you for the later, but you couldn't get that now. So if you were making $300,000 a year and you wanted to take it at 62, pretty much all of that is going to come back, right?
Interesting. Okay.
Because it goes off of $3 or $2 over $1 has to go back, right?
Huh.
So it's a calculation that they have there.
And to your original question, are we getting less? I think it just feels like that because things have gotten very expensive, right? So if you look, maybe go back to the 80s or whatever, if you were in Silicon Valley, California, and you were claiming Social Security, you were getting by and everything. If you live in Silicon Valley now, right, over the past 40 years, and that's not getting you much. So Social Security does inflate, right? They do factor in inflation, but it's an average across, different areas and against different sectors and everything. So it does inflate, but that doesn't necessarily mean it's going to inflate dollar for dollar with your lifestyle or with your area. It's just sort of a national average based off of a certain number of things. And then one last point. So you said that they tax you on the income and then they tax you on Social Security. So if you end up saving that, there's inheritance tax too. So
great.
Just one more time.
So is the best practice generally to wait until you do retire from a full-time position before you take that Social Security?
Yeah, most of the time.
Yeah.
If somebody has a health issue, right, and they're 62, right, may say, hey,
I may not be around to wait for it to come to its full value.
Right.
Yeah.
And once you hit full retirement age, they don't decrease the benefits for working. That's just if you're taking it early.
Yes. Yeah.
So that's an important factor too. Once you reach, like, let's say your full retirement age is 67, you can file at 67 and you don't get that penalty for, earning a certain amount.
Yeah. But a lot of people don't want to wait until their full retirement age to start taking it because they're like, hey, my friend's 65 and developed a lot of health issues and couldn't enjoy retirement. So I'd rather take a little bit of a penalty to be able to know I have this amount of money that I can enjoy while I'm able to enjoy it, travel, whatever.
Yeah.
You could run break-even numbers too on everything. And is that where you're going?
Yeah, I was just going to say, you can run a break-even calculator and, tell people, do you want to win the game, so to speak? That I
want to win the game. Any game, I want to win it.
You got the maximum benefit, or at 65, could you enjoy those dollars now versus waiting, down the road, right? Maybe you retired at 65 and you really want to travel and you want to start enjoying those dollars now, right? There's also, people have different fears and beliefs of, is it going to be there forever too, right? And that drives people to make that decision. Hey, I'm going to start taking it earlier, because there's $37 trillion of debt out there that. My biggest worries for us two in our early 30s and for our generation is it's a lot of debt that's going to have to be paid back one day. So that could be a whole separate discussion.
Part 3.
Yeah, really.
Are you two planning for that then? Are you planning that there won't be any type of government assistance by the time you're retirement age? Is that your mindset?
Yeah. So, and we do work with younger people, right? And we build retirement plans. The way we look at it, it's there now. And you kind of have to plan with what you know.
Yeah.
So it is in place. I would say for us, maybe the age gets delayed, right? Instead of 67, maybe it's 70s full retirement age. But you kind of have to just work with what you know, right? For example, the tax code, right? Brackets are at a pretty favorable place over the next 30 years. Do we know if they'll go up or down? No. And that makes a conversation of, Roth versus traditional difficult, because it's, when we would pull money out in retirement, that's a whiles away. I don't know what the tax code's going to be then. So you kind of just have to plan for what you know now. But if I had to guess, I would think something along the way will change, whether it be a reduction in the amount, an extension of when you can claim, and you can just kind of plan for what you know right now. But I think if you're young and you have the ability to save, I would say save like it's not going to be there. Because once again, if it is,
great.
it's great. That's awesome. Sweet. Now you're, flying business economy, get a little extra leg room and stuff, right?
What's that like?
To answer your question, I was going to say, just me personally, I'm planning for it not to be there. I think it most likely will, but just to be more conservative, personally, that's how I plan.
Yeah.
Tim and I were preparing for this and talking about long-term care or some kind of retirement home living. Most people will probably face that if they live long enough. And, what you were saying, it's like $10,000 minimum for even not the greatest probably care facility. So how do you advise people maybe our age or maybe even younger to plan for that? What do you say to them?
So there's a couple options out there, right? You could get long-term care insurance. And that can be very expensive. There's products that are kind of like a hybrid. That could be an annuity product that has like a long-term care rider on it. And again, those products are very expensive because we'll see sometimes clients with some of these older policies, and they're really good policies, and you can't get those anymore.
And you're like, do not stop paying
Yeah, well,
the premiums.
Yeah, I mean, we unfortunately had a newer couple come into us, and they were telling us, one of their parents had stopped paying without telling any of the children.
Yeah.
And we always, discuss with our clients, if they do have like a long-term care policy, hey, before you say, hey, I'm going to stop paying on that, talk to your children about that, because your children may even say, hey, we'll even kick in if it's a burden for you, because that's what the insurance company is hoping that a lot of people do, is walk away from those policies when they need them most, right? So there's insurance that you could purchase, and some other types of products that you can invest in, but you can also just invest to say, hey, I want to build a bucket separate from my retirement to have as a buffer there, right? And there is, for folks that are older, there are some strategies from an estate planning perspective where you can protect assets, right? And you want to work with a licensed estate planning attorney on that, but there are ways to protect assets. But yeah, it's a real worry for a lot of people. I would say most people run the risk and they self-insure, so to speak.
Okay.
And we do have clients that, hey, even if that happened, and in the software that we use, we could say, hey, if you did have a long-term care event for 5 years, right, what would that do to the overall plan? And you had to take that from your retirement assets. Does that plan still work, right? So there are, some folks that don't need that insurance because they would be fine otherwise, but there's some people, that could be detrimental to their plan.
Sure.
Yeah. What we see a lot is the people who need it can't afford it. The people who can afford it
don't need it.
Don't really need it.
Yeah.
And there's like
It's
maybe
interesting.
someone right on that fine line that where it goes both. But it is. I mean, it's expensive, but people are living longer.
Yeah.
You've got to pay people more to staff there. I mean, how many times have you heard of staffing shortages at these places? It's tough
all
to
the time.
get skilled care. So it's expensive, I think rightfully so, but it almost is prohibitively expensive for the people who need it when you look at these premiums and what it would cost them every year to keep that insurance.
Yeah. Is there, and you may not know this, is there an average length of time that someone spends in a nursing care facility at the end of their life?
I don't know either. And I know that there's differences between men and women on how long they're typically in.
Probably women are
facilities.
longer, I would
Yeah.
imagine, because they do tend to live a little bit longer, I think, lifespan wise.
Yeah. But I don't know the official.
Yeah. I don't either. My mom was in at the end of her life, but only for 2 years, thankfully. And she had an unusual circumstance. It was a great place. Nobody wants to think about that, but
Yeah.
you have to plan for.
When we always, when we do those retirement planning meetings, we say, hey, something that could drastically change this, right, is a long-term care event. So we want to show that scenario with, hey, this is an issue.
Yeah.
Well, some people it's not an issue, some people it is, right? And just make sure that, you want to make sure you present all the options to people to say, hey, this is a risk.
Yeah.
There's ways you can do it, or you can take the risk, right?
Alison and I were prepping for this podcast. I had some conversations with folks in our finance department, and they asked me, can I pose a couple questions? So if you don't mind, I'm going to read a couple of their questions.
Sure.
We don't really understand what they ask because they're finance people.
I'm going to read it, and you guys. So first question, how should I balance steady income such as bonds and annuities versus growth investments such as stocks?
I think an important concept, we use it, a lot of people use it, it's, buckets of money, right?
I'd like to have buckets of money.
Yeah, right? So it's physical buckets that you will carry around.
I mean,
and the whole premise is there's money you need in the short term, right? You get a direct deposit right now. You need to pay your bills. You need to get gas. You need to get groceries. That's ultra short-term money. And then when we're looking at it in, more of a broader picture, there's money you're going to need in the next, let's call it 0 to 3 to 5 years, right? That type of money, maybe you don't want fluctuating as much. Here's money you won't need for maybe 5 to 10 years. That's money you could probably take a little risk, but you want to know it's, not going to be crazy volatile in case you need it. Maybe, hey, we're considering getting a place down in Florida. We're near retirement and we don't really know yet, but we may want to. So maybe you could take a little risk if it's up and downs. But, the money that you say, well, this amount we don't really need for maybe 10 plus years, you could become a little bit more aggressive. And then in each of those buckets is where you start using, like you said, some, maybe equities on the longer term stuff, maybe more fixed income that's providing, current payments for money that's a little shorter term and maybe a little less volatile. But it's really important to map that out. Everything always comes back to what's appropriate and, what's in the budget. And that's why, it's important working with people who do this, because oftentimes clients don't really know, right? Like if I said, hey, how much should you have in your short-term bucket in your fixed income position? You'd say,
I don't know.
yeah.
Ask
Where's
my
the
husband.
bucket? I don't even know where I put my bucket. So I would say everything has its own merit, but it's all going to depend on when you need it. What's the use? And if it's short term, it's one answer. If it's long term, it's another. And I think, that's the most appropriate way. I think people don't realize how much they're going to need short term versus long term and everything.
Here's another question. This is a two-parter. Can you describe the difference between a traditional IRA and a Roth IRA?
So a traditional IRA, when you make that contribution into a traditional IRA, you get a tax deduction now, okay? Now, when it grows tax deferred until you take it out, and you pay taxes on it when you take the monies out, okay? A Roth IRA, you put money into a Roth IRA, you don't get a tax deduction now, but it grows tax-free for the rest of your life. So when you take that out in retirement, you won't have to pay the taxes. And I think I know where it's going with the part two, but
Well,
That seems like a better option.
yeah, that's the question, is which one is better as you approach retirement age?
right. So, and that really depends on the length of time too, right?
Okay.
For in where you're at in the stage of life, right? If you're just starting out and you're not in your peak earning years and you're in a low tax bracket, but you think in the future you're going to be in a higher tax bracket, you want to contribute to Roth, right?
Okay.
If, hey, you're in your peak earning years and you're making more money than you're probably that you're not going to need to fund your lifestyle and retirement, and what you're taking out is much less, right? Say if you were making $500,000, but you're going to live off of $200,000 in retirement. It's a big difference in what tax bracket you're going to be in. There you might want to do traditional, right? And take that tax deduction while you're in a higher bracket, right?
Okay.
But as we alluded to earlier, tax code can change. It's not permanent. So it's not just an easy answer, right, to say, hey, do I do traditional or do I do Roth? It kind of depends. What if you're a high earner and you're in your 30s? Do you do traditional or do you do Roth now, right? And just alluding back to, hey, there's $37 trillion of debt. Do we think taxes are going to go up in the future opposed to where they are now? Maybe you say, hey, I'm betting that taxes are going to be higher in the future. I'm actually going to do a Roth now.
And there's a couple other factors too. One, what's the plan for the money? Some people, we said it at the beginning, they have high dollar figure balances and they live very frugally. And what they have, they want to leave to their children. Well, let's say you maybe are in, you're still working and you're in a 24% tax bracket. And, but you're saying, well, this money's, I'm probably not going to use it. It's going to go to my child. Everything I'm stuffing away right now, I already have enough to live off of. Well, if your child inherits something, they're going to inherit it traditional or Roth. Let's say your daughter's a neurosurgeon and she's a very high earner in a high tax bracket. Well, whatever they inherit, they need to pull the money out and it's going to be at their tax bracket. So maybe you want to think ahead a little bit. Maybe the numbers work out where you should do traditional now because if you were to pull it out in retirement, it'd be lower. But actually this bucket is not for me. This is more legacy money. So now I need to start thinking ahead. A couple other things. There's required minimum distributions on traditional pre-tax contributions. At a certain age, the government says, we gave you a tax break on that money. We didn't make you pay federal income taxes when you put it into this account. But the government's not that nice. Eventually, they want their money, right? And they don't want it to just continue to grow. So at a certain age, they say, okay, you need to start pulling out. It's called a required minimum distribution out of that account every year, whether you want to or not. We have clients who don't need the distribution, so they take it out, right? It's taxable income, and then they just invest it into a non-retirement account. So there's some other ancillary factors, too, that play into it. A lot of people focus on the numbers of it, but, the long-term goal, too, may sway the decision against what the conventional math may work out to be.
And there's some strategies too around like what's called a Roth conversion, right? So maybe you retire at age 60 and you had 2 years worth of cash to cover any type of expenses. So your income's going to be zero in a particular year, right? Well, right now, things go from the 10, 12 to 22% tax bracket, right? Although you might not need that money that you have saved in a traditional IRA or a traditional 401k, you may want to elect to have that taxed now versus possibly in the future, right? So you could either take it out and put it in a non-retirement account, or what you could do is you could actually turn it into a Roth. And you don't have to do the whole IRA or the whole 401k. You could say, hey, I want to max out the 10 and the 12% brackets, turn that money into Roth money and have it grow tax-free for the rest of my life. Now you pay the taxes now on that, but you're eliminating, some possible future risk of being a higher bracket later, right? Especially if you have those large RMDs that you may not need all of in the future.
What's an RMD?
Sorry, the required minimum distribution
Oh,
that
gotcha.
Vasilios was saying.
All this fancy
Yeah,
accountant talk.
we're not supposed to use acronyms.
Yeah.
but no, but so there are strategies that people can be taking advantage even if in retirement, right?
Yeah.
To be able to do things like that.
Yeah.
So let's say I retire in year 6, the stock market tanks. What do I do? And how long do you think it will take for me to make some sort of comeback with that? Is there sort of traditional numbers that you've seen or?
Yeah. So I think if you were allocated appropriately, you'd be a little less nervous, right? So earlier this year, tariffs went into place and there was a significant market pullback, right? We got a couple calls, but honestly, we didn't get that many calls from our clients. If, we know if clients have sort of the spigot turned on from their accounts with us, right? If they have distributions, and we're setting those aside and maybe some money market funds, still earning some interest, but not subject to the volatility of the market and everything. So if you're positioned appropriately, you'd be affected most in your long-term bucket, right? The one that'd be more aggressive, but that's the one, right? We said we're not touching for 10 or plus years.
Mm-hmm.
The medium-term bucket probably fluctuated a little bit, but again, that's money we said you don't need for maybe 5 years. That short-term bucket, hopefully, didn't move around too much because we've had it invested a bit more conservatively, right? Yeah. Maybe some shorter term bonds or some treasuries or money markets and other things, depending on how much you're actually going to need and pull from. So if you were just retired and everything was in the market and your account dropped by 20%, there's no telling how long it'll take. Recently, and I've been saying this to a lot of clients, we've had pretty quick market rallies after a down event. April's a good example. Market was down and then it shot back up and it's positive for the year. 2020 market was down and by year end it was positive. So in recent memory, it's been quick rides back up, right?
Yeah.
So people, I think, have become a little used to that, but it's not always the case. In 2008, it took a good 4 years, I think, until the market was flat. That's pretty significant. So I always try to coach clients as well. It's not always going to be like this. There's, there may be a time where there is a market pullback and it doesn't shoot up 2 months later. And, I love the market pullbacks because I can just put money in and it doubles in,
and my bucket gets really heavy.
Yeah. There are times where it's more significant, but ultimately, if you're appropriately allocated, you should have a little bit more comfort. There's always going to be, depending on who it is, a little bit of an unsettling when the market's back. But if you know like what you need over the next few years is not subject to such wild fluctuations, I think you'd be a little bit more, resilient in those times.
To get a little bit more granular, to like say for example, it was 2008 when this was year 6 for you were in retirement, right? The stock market was down 50% at one point. The bond market was actually positive for the year, right? So going back to Vasilios saying if you were properly allocated, right, you can take from that bucket that's actually doing well and allow time for your equity bucket to grow back up, right? And that's why, heading into retirement, you don't want to have all your eggs in one basket of, hey, all equities, because if equities are down, that's the only bucket you can sell from.
Yeah.
To meet your distributions that you need to live, right? Although that the stock market's down, you may have other areas of your portfolio that are up if you're invested in different things where you could take from those buckets and not have to sell stocks at a low point.
Do you generally find with your clients that maybe have a little bit more disposable income before retirement that it's better to invest in these types of bonds and equities, or is there something to be said for investing in material assets like homes, real estate, things like that?
Yeah, I think that's investor dependent, right? Some people love real estate, some people don't, right? Some people have the know-how, right? It's a bit more active, right? Even if you have a management company, there's still things you have to do. It still takes time. It's still a headache.
Yeah.
It's not like with anything in life. It's not easy to just pick something up and make money off of it, right? If it's your first rental, it's going to be a lot of learning curves and everything. So some people, they've done it all their lives, or maybe their family have, and they have experience with it. And we have a number of clients who do have rentals and everything, and maybe their goals are, okay, every few years I'm going to end up selling one in retirement or this and that. But ultimately, we're not here saying, hey, client, you're about to retire, you should go buy 4 rentals and do this and that, because it's, those types of things take time. Now, if they already have that built in, then it's a different story. Now we figure out how it plays into their situation and how, that will go through their retirement. Maybe they want to get rid of them. Maybe they want to pass it along to their children, and that was the whole reason for them. But, there's investing in the market's one thing, and then getting into some other things like real estate that can be, a bit more active is in a completely other beast. Now, there's still access to like real estate as a sector in investment accounts and everything in the form of real estate investment trusts and allocations to different things. But everything sounds great too, and a lot of people put that on the internet too. And you just need to buy this and then leverage it for that and everything. But it's also a lot more difficult now that rates are up, right? When it was free money, it was a lot easier.
I wouldn't be investing in a lot of real estate right now.
Interest rates have crept up, and it's definitely put a ding into the profitability.
Yeah. How do you feel, Tim? Do you feel like you're ready to retire? You have all the knowledge you need?
I do have a lot of knowledge after this, but I'm not ready to retire yet.
Yeah.
So a little bit more. But so, guys, is there one thing that we addressed today that you'd like to reiterate to really make sure that we take this with us as we plan? What is one or two pieces of advice that we can really move forward with?
Yeah. When clients come in, the number one question they ask is, are we going to be okay?
Yeah.
Can I retire? Right. And really making sure you come up with that plan. It doesn't matter if you're 30 or you're, 65. Most people want to retire or have that comfort knowing that they can retire, right? And really taking the time to come up with a plan to say, hey, what is my outlook for retirement? So when you meet with somebody like us, you really want to make sure, you have that in line to say, am I going to be okay, right? Because some people don't have a plan. There's different phases of life, what you should be doing, but for most people, it's a common goal of wanting to be able to retire.
Yeah.
For me, it's be serious about it. We went through a lot of topics, right? Some maybe you knew. I'm guessing a lot maybe you didn't. Yeah. And this is something you want to be serious about. It's really easy to keep putting these things off. Maybe I'll work a few years. Oh, well, I don't have time. Oh, I got to travel here and there. But this is serious. Like, it's not going to happen if you don't put in the work to make it happen, right?
Sure.
You're not going to feel comfortable if you don't take the steps to feel comfortable.
Yeah.
And if you start working with someone, take it serious. People like us can only do our jobs well if you're giving us all the information. If you're giving us a detailed budget. You're mapping out what the next 3 to 7 years or 7 to 10 years are going to be like, right? So it's a very serious matter, right? You go to your doctor every year, you get a physical because health is serious. This is something else you should take serious. It should be something you're monitoring, budgeting, planning. I mean, it's the rest of your life. It's how you're going to live. It's the tactical decisions you're going to make. It's what your children will inherit. They're really big decisions. So, take it serious too, right? Not everything falls, just like not everything falls on your doctor. Your doctor can give you a recommendation. And if you don't take it, that's on you. So it's the same with this too. You could say, well, I have an advisor, but you also, listen, take it serious, do the budget, like be serious about it is, I guess, the biggest thing I hope people take away from this, because it's your life. And if you don't, then it's your life.
Yeah. And I also, we touched on this a little bit when you were here last time. I think there are some people who think going to a financial planner is only for the wealthy. And I think it's really important that they understand that that's not the case. It really doesn't matter what your current economic level is. That you, like you just said, you really want to take this seriously and plan ahead. And that's really what a financial planner can help you do, is take what you have and grow it to the best of the ability that is available, right?
Yeah.
Mm-hmm.
So I really feel like that's an important message to send out. If you're, no matter what your age is, no matter what your income level is, you know, if you haven't yet gone to see someone who knows more than you, because he used a lot of words, I don't even know what they mean, if I'm being completely honest. So that's what you're there for. Like, I wouldn't write my own will. I'd go to a lawyer because I know that they know more than I do in that field. So
Right.
yeah, it's really
Although
helpful.
I do go on WebMD before I see my doctor. And
That's true, but every time I go on WebMD, I'm convinced
Yes.
I'm going to die, so
Yes,
I
it's-
probably should stop doing that.
it should be a banned website. Common people should not be allowed to go on WebMD because I'm the same way. I'm
Yeah.
like, I have a headache. I think I'm, my
Yeah, aneurysm,
I think-
automatic. Yeah.
I think my neck's broken.
Yeah. Well, thank you guys for coming here. This is so
Fantastic.
helpful.
Thank
Thank
you
you
for
very much.
having
Thanks
us.
for having
Yeah.
us. Appreciate
Yeah.
it.
We always enjoy having you.
Awesome.